Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate filings and find out if a company is truly thriving or just surviving. Get ready because FitLife brand's latest report has some interesting twists and turns, especially after a pretty big acquisition. And hey, quickly before we dive deep, if you love getting these kinds of no BS breakdowns, make sure you are subscribed and join our Discord community linked in the description below. It is the best place to connect and dig even deeper. Alright, so we are looking at FitLife Brands Incorporated's quarterly report specifically for the period ending the 30th of September 2025. Think of this as a status update on how the company has been doing over the last few months. Let us check out the company's financial snapshot. As of the 30th of September 2025, total assets landed at about $109.9 million. Now that is a pretty solid jump from $58.5 million at the end of 2024. This usually means the company has either grown its operations or made some significant acquisitions. Liabilities also went up considerably from $22.4 million to $68 million. This is mainly due to taking on new debt to fund that growth, which is pretty common after big deals. Now, where is the money coming from? For the 3 months ending the 30th of September 2025, revenue shot up by 47% to $23.5 million. That is a huge jump from $16 million in the same period last year. This surge is largely thanks to a new acquisition and stronger sales from one of their brands, Muscle Farm. Looking deeper into how much they make on their products, gross profit for these 3 months grew to $8.7 million. Up from $7 million a year ago. That is a 25% increase. However, their gross margin, which is the percentage of revenue left after accounting for the cost of making their products, actually dropped. It went from 43.8% last year to 37.2% this year. This means they are making more money overall, but each dollar of sales is bringing in a little less profit percentage-wise. And what is driving these big changes? Well, a massive factor appears to be the merger and acquisition costs. These jumped from just $59,000 in the third quarter of 2024 to a whopping $820,000 in the same period of 2025. This clearly shows the company has been busy buying other businesses. So, what does all this mean for the bottom line net income, which is what is left after all expenses, took a hit for the 3 months ending the 30th of September 2025. Net income was $921,000. That is a significant drop from $2.1 million in the same quarter last year. This decrease is mainly because of those higher expenses from the recent acquisition. Let us see how things look over the longer 9 months period. Revenue for the first 9 months of 2025 increased to $55.5 million from $49.5 million in 2024, a 12% rise again. Growth is good, but it is important to see if the profits are following. Operating income, which shows how profitable their core business operations are, dropped noticeably. It went from $10.2 million for the first 9 months of 2024 down to $7.8 million for the same period in 2025. This 24% decrease highlights that while sales are up, operating costs have outpaced that growth, and that decline in operating income trickles down. Net income for the first 9 months of 2025 was $4.7 million, down from $6.9 million in 2024. That is a 32% fall, and it emphasizes that managing those post-acquisition costs is crucial for FitLife Brands right now. Now let's talk about that big elephant in the room, the acquisition of Irwin Naturals. This happened on the 8th of August 2025, and the company spent about $42.5 million on it. They used new loans and some of their own cash for this deal. This acquisition is a major reason for the increased debt and those higher merger and acquisition costs we saw. Part of that acquisition cost is attributed to intangible assets like brand names and customer lists, which are valued provisionally at $25.5 million. Goodwill, which represents the premium paid over the fair value of net assets, is another $6.3 million. This is pretty standard for acquisitions, but it will be interesting to see how these values hold up over time. Interestingly, FitLife Brands has also entered into an interest rate swap agreement. Essentially, they are trying to manage their risk from fluctuating interest rates on their new debt by locking in a fixed rate on about half of their term loan. This is a smart move to create more predictability in their finances. Let us look at EBITDA, which is earnings before interest, taxes, depreciation, and amortization. For the 9 months ending the 30th of September 2025, it was $7.9 million. This is down from $10.3 million in the same period of 2024. And when we look at adjusted EBITDA, which removes things like stock, base compensation, and merger costs. It also shows a slight dip from $11.1 million to $10.5 million. While the company is performing well operationally, these figures show that the heavy costs associated with growth are impacting reported earnings. Back to the balance sheet, as of the 30th of September 2025, total liabilities stood at $68 million. This is a significant increase from $22.4 million at the end of 2024, largely due to that new term loan and credit line used for the Irwin acquisition. Stockholders' equity, however, still grew from $36.1 million to $41.9 million, showing that despite the debt, their net worth has increased, which is a positive sign indicating that the assets acquired are likely worth more than the debt taken on. And looking at the revenue breakdown for the quarter, online sales made up about 44% of the total, while wholesale was 56%. This is a big shift from last year when online sales dominated at 68%. The acquisition of Irwin, which primarily sells through wholesale channels, is clearly reshaping their revenue mix. In their cash flow statement, we see that cash from operating activities was $7.2 million for the first 9 months of 2025. This is down from $8.7 million in 2024, which again points to the impact of lower net income on their cash generation. Investing activities show a massive outflow of $42.5 million, almost entirely due to that Irwin acquisition. And financing activities show a large inflow of $34 million, confirming the borrowing to fund both the acquisition and pay off previous debts. Now, looking at these results more broadly, FitLife Brands has clearly embarked on an aggressive growth strategy through acquisitions. The Irwin Naturals deal significantly boosted their revenue and diversified their sales channels, shifting more towards wholesale. However, this growth comes at a cost. We see a noticeable increase in liabilities and merger-related expenses, which have put pressure on net income and margins. The company is dealing with the typical growing pains of integrating a large acquisition, and it will be crucial to watch how well they manage those new operations and debt levels going forward. Their gross margin contraction is a concern and will need to be monitored to ensure it does not become a long-term trend. The move to more wholesale business is a strategic shift that could pay off if they can effectively manage those channel dynamics. Alright, that is our breakdown of FitLife Brand's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the Irwin acquisition will be a home run or a tough climb? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to keep the conversation going. Thanks for watching, see you next time.